Welcome to Inside Economics. I'm Mark Sandy, the Chief Economist of Moody's Analytics, and I'm joined by a few of my colleagues. Of course, we've got Cris Dries, the Deputy Chief Economist. Hey, Cris.
Hey, Mark. How are you doing?
I am doing well, and you?
Yeah, same here.
Anything going on? And you're in the office in Westchester, PA. Anything going on in Westchester?
I got a little bit of a cold November rain here, so that's about it.
He didn't get it, Cris. He didn't get it.
You didn't get it?
It's a Guns N' Roses song.
It's his favorite band.
Guns N' Roses?
Yeah.
Yes, yeah.
Oh, I missed that.
Oh, you have to go back. Give it a listen.
Okay, very good. I did. That was right over my head.
Oh, sorry about that.
Yeah, and of course, Dan White. Dan, that was Dan's voice. Hey, Dan.
Hey, Mark, you look warm. You look much warmer than here.
I am, but I'm not going to tell you where. I am a little warmer than you are, but looking forward to being back in good old Pennsylvania relatively soon. Making my way back, and Emily Mandel. Emily, it's good to have you.
Yeah, good to be here.
Yeah, and Emily, this is your second time.
Second one. The first one was the one where we introduced the world to your newfound love of Guns N' Roses. So apparently that has not persisted since then.
Now it's apropos. Okay. I'll have to tell you, the digger I deep into Guns N' Roses, the less I was impressed. I know that sounds bad, and I'm sure I'm going to get mail, but I didn't. The top 3, 4, or 5 songs are fantastic, and then after that, I don't know. It didn't resonate with me.
You don't need to go too much deeper than that.
Okay, fine. You can listen to the 4 or 5 songs forever. Yeah, but yeah, very good. You know what group I've run into recently that I really like, and maybe this reveals too much about me. I'm not sure. 1975. Have you heard of 1975? No, I think it's a Generation Z thing. I think it is. We're going to come back and talk about the election, but did you hear about this young fella, I believe in the Orlando area, who was elected to Congress? He's like 25.
Yeah, the first Gen Z one. Yeah.
He's Gen Z, right? Gen Z. So I was listening to a NPR interview of him, and he was saying, "Oh, I'm going to go to a 1975 concert." And I go, "That's my band. That's my band." So believe it or not, I'm right in there with the Gen Z.
That's why you don't get Guns N' Roses, because you're just younger and hipper than all of us.
Yeah, there you go.
Right. There you go. It's like, and now I'm definitely going to get mail. It's like the Maroon 5 of the Gen Z generation. And they're going to say, Maroon 5, who the hell's Maroon 5? Do you guys know who Maroon 5 is?
Yeah, we know Maroon 5.
Yeah.
Everyone knows Maroon 5. But it's good. I was like running on the treadmill the other day with 1975. They got really catchy, upbeat, melodic, it's really, really nice music. So anyway, I'm always looking for music for my treadmill. I need that music. Okay, and of course Dan runs anything government related for us, and Emily is our maven on state and local government issues. They're here because we had the midterm elections this week, and clearly we want to talk about that and what it means for economic policy. But before we do that, go down that path, of course, the other big news this week, economic news, was the Consumer Price Index report, CPI report. Inflation's top of mind, and a lot to talk about there. But let me turn this back to Cris. And I was going to say something else, but I won't say it. You can tell I'm in a good mood. I'm in a good mood for lots of different reasons. Lots of different reasons. One of which is that CPI report. It really put me into a good frame of mind. We thank goodness for that report. But anyway, Cris, give us the rundown.
Yeah, thank good. I think last week we were talking labor report, and we had that little debate about bad news being good news being bad news. I think this week we can definitively say CPI inflation was good news being good.
Hey, Cris, can I say one thing on that
before
we move on? And then I want to interrupt you.
Okay.
And I'm notoriously bad at this, but we were nervous about what people would think of that. Someone called it bickering, and actually that's the right word for it. We were bickering. And we were nervous. Well, what will people think of that bickering? I think people like that bickering. That seems, yeah.
I was surprised. I didn't think they would at all. It was kind of like to me, it was like watching 5-year-olds play soccer, but that's entertaining as well, right? So,
Yeah, I
but
think
I've
you're
gotten
right.
I've gotten a lot of positive feedback that say, oh, one thing that I think there's this myth that we are some monolith here at Moody's Analytics, right? That
Oh, yeah.
there's only one opinion and that's it. Nobody else has any other difference. So I think they appreciated that, we listen, we debate, we are in search of a truth here, and it gave them a little insight into some of that backstory, if you will.
Yeah, so if you
disagreeing
were
with
a listener
Marcus.
to this podcast, you should go back and listen to that one. And by the way, that did generate some really interesting email conversation internally about forecasting
Yeah.
from Camille Kovar, who's been on the podcast before in particular. And I started writing a response, but the email he wrote to me was so full of interesting things. It's going to take me a while to respond to it all, but I thought it was really cool. Dan, you were going to say something.
Same.
I was just going to say, disagreeing with Mark is one of the funnest parts about working here.
Absolutely.
You can disagree with your boss and not get fired, because that's the whole point, is we're supposed to be debating and talking about this.
Oh, I thought you were going to say because you can always win those debates. I thought that's what you were going to say.
What's the best part about economics? It depends, right? So I think I won the debate and you think you won the debate. We're all happy at the end of the day.
Everyone's happy. Great profession. Great profession. Yeah, anyway.
Well, back to the CPI.
Back to the CPI. Far away.
Good news was good news. Headline CPI was 7.7% year over year. That's down from 8.2% in September. And I believe the high was 9.1% in June. So we are moving in the right direction, and actually moved a bit more swiftly than I think either we or consensus anticipated in terms of the decline. Even more encouraging was the core, all right? So stripping out food and energy prices, that's down to 6.3% on a year-over-year basis, 0.3% month over month. It had grown 0.6% month over month back in September. So that's a nice improvement, again, in the right direction. In terms of what are the factors that led to the improvement, we finally saw some significant improvement in used car prices, right, down 2.4% on the month. We had been anticipating that for a while. Other data was indicating that, and now it's finally materialized to a larger degree in the CPI. Apparel prices are down, so I think we're also starting to see the supply chain effects kind of work themselves out. So we maybe even have too much inventory when it comes to apparel because of the over ordering that went on during the pandemic. So prices are coming in there. And then medical care. Medical care came in. There's a little bit of a quirk there, though, related to health insurance. I'll briefly say, I don't know how much you want to get into this, Mark, but
I think you need to just a little bit, because it was health insurance premiums actually fell. And it contributed meaningfully to the weaker core CPI number. So maybe you can just dive into maybe not go all the way to the bottom of the ocean here, but maybe halfway down.
And I think we talked about this maybe last time, actually, because in our discussion. But healthcare or health insurance premiums are difficult to measure, right? And they were down a lot this month, so it's down 4% month over month, right? It's a huge decline, relatively speaking. But health insurance is it's notoriously difficult to actually measure properly, right? The premiums that employees are paying can change, but the plan can change as well. So quality adjustments become really complicated. We know that there are already issues when we think about how to quality adjust smartphones or computers, and health insurance is, in some sense, I would argue, even more difficult. So there is this complex formula that certainly, if you're interested, go check out on the BLS's website. But essentially what they do is say, you know what, we're just going to look at the profits of health insurance companies. And those changes in profits on a year-over-year basis should be a good proxy for changes in prices, right? So if there are more profits that the health insurance companies are accumulating, then that implies that the prices of health insurance have gone up as well. What happened was with the pandemic, right? We had a lot of we had insurance premiums being paid in, but not a lot of claims being paid out at the height of the pandemic, right? There was a lot of elective surgery that was postponed. right? So health insurance companies actually on paper looked as though they actually did make large profits back in 2021. Now, as a year later, we're starting to see that unwind, right? So now we are going back to the doctor, we are going back to the hospitals. Those profits are coming in, and again, based on this quirk in the timing, it looks as though the prices of health insurance premiums are coming down based on this methodology. In reality, we know that employees are kind of paying the same or perhaps more in terms of their actual premiums. So this is, again, one of those quirks or anomalies in the CPI calculation. In this case, it's working in favor of putting downward pressure on inflation. It's going to continue to do so probably for the better part of 2023 as well. Now, it's not a huge part of the consumer basket, right? It's less than 1%. So it's a big number in terms of the decline in the insurance premiums paid, but in terms of the overall impact on core inflation, it's relatively small.
So taking a step back,
Yeah.
it feels like today the report for October suggests that inflation is definitively rolled over. It's peaked. It's coming in.
I don't like to use definitively anymore with the inflation.
That's a good point.
But
Good
you know,
point.
we've been but it appears that way. Certainly, it's coming in.
Unless something else changes.
Correct.
Unless oil prices spike or
Yeah.
COVID lockdown in China or whatever. Assuming nothing goes off the rails, it feels like it's peaked.
Yeah, the trend seems to be downward. The speed might be different, but
right. And that very smallish, let's call it, decline in core CPI in the month, 0.3%, because they had been coming in 0.5, 0.6.
6, yeah.
Yeah, that 0.3 probably is overstated. The case here is overstated a bit because of this quirk with regard to health insurance, but it's still a case. There's still a case that inflation's okay.
Yeah, let's say it's 0.4, right? Worst case.
Yeah.
That's still improvement. All right.
Right. And of course, just for context, I mean, for inflation to be back to the Federal Reserve's target on CPI inflation, which is a little bit different than the consumer expenditure deflator measure of inflation, which is what the Fed typically is targeting. But looking at CPI inflation, it feels like we need to start getting 0.2s, 0.1 maybe thrown in there every once in a while to get it down to about somewhere in the mid twos, 2.5% something like that. So we're the 0.3 is good.
Yeah,
we'll take it. Clearly, the stock market took it. They loved it. Bond market took it. They loved it. But to actually get back to the Fed's target, we got a ways to still. We still have a ways.
I think they might have loved it a little too much. Might have extrapolated a bit there. But
We can
talk about that.
They jumped all over it, right?
Yeah.
Right. But before we go there, any other things in the report you want to call out? Any other aspects of the report you want to call out? I noticed that food price inflation still strong, but that moderated, which is we've been waiting for that as well, right? Because diesel prices have come in, and a big part of the cost of food is transporting the food from the farm to the store shelf, and lower diesel prices help. So I noticed that. Anything else you noticed in the report?
Housing, so shelter is the other big one, right? We've been saying that that's going to continue to be a drag on inflation, or continue propping up inflation, to be specific, for a while. It actually did moderate a bit. Rents grew 0.7% versus 0.8%. So that's encouraging, but lots of script yet to be written there. So it's still too high, right?
Right.
So at least for another couple of quarters, I would think we're going to continue.
The other thing I noticed is there's some things that made me feel better about the future, right? So for example, new vehicle prices that continue to increase. Yeah. Right. And there's gravity is going to set in there at some point once vehicle production around the world normalizes. I think vehicle production here in the U.S. is normalized, back to pre-pandemic levels, but not in Germany, not Japan, where a lot of cars are produced, and we could, here in the U.S. consume a lot of those cars and vehicles. But as that production normalizes, which you would expect with the easing of supply chain issues all around the world, we're going to see more production, rebuilding of inventory, and we should start to see new vehicle prices at least level out. But I would even expect some declines, right? And that also sounds like a small component of the CPI, but these have been big changes, and if they go away or go down, that could have some meaningful impact on core as well.
Yeah, the price is moderated. I mean, they're not growing as fast as I recall new vehicles. I think they were 0.7 and now they're 0.4.
Yeah,
month over month. So
I think our colleague Mike Brisson, who is a great economist for the vehicle industry, points out that this is reflecting the 2023 model year, these prices, and because pricing has been so strong, they've raised those 23 so-called MSRPs, those prices, the listed prices, and that's what's flowing through right now. But on the other side of this, as you make your way into early next year, we should start to see some meaningful moderation, at least a flattening out of new vehicle prices. At some point, I would expect a decline. But that made me a little bit more, gave me some encouragement about inflation in the future.
To back that up, Mark, we were just at a conference. Actually, Emily and I were at a conference the other day, and for the first time, I think in any conference I've ever been at with state officials, the people from Michigan were maybe the most optimistic in the room. They are never the most optimistic people in the room, but they were so excited that the microchips were finally showing up for some of those cars, and some of those cars were starting to roll off the lots, that I've never seen them excited as they were.
Oh, is that right? Okay, that's interesting. So revenues they're confident in revenues because we're going to get more cars, more vehicle sales, more production. Yeah.
Right, and they're ramping up production again for the first time because they didn't have any chips to put in the car, so they ramped it down for a little while.
Yeah, it makes a lot of sense. Hey, Cris.
Yeah.
You mentioned the market reaction. What was the reaction with regard to what it means for monetary policy? If you look at the futures market for the federal funds rate, which is the key interest rate the Fed controls, do you have a sense of what they're saying now?
Yeah, it came in. Well, at least immediately. I didn't check it today. I probably should. But yeah, now the assumption is the Fed may not have to be quite as aggressive in terms of hiking rates, and the terminal rate may not have to go to whatever 6%, as some were thinking. So it might a more modest reaction if in fact inflation is coming in and can stay on this downward path.
So I think it solidifies the idea that the Fed's going to raise the funds rate at the December FOMC meeting.
Yes,
by a half a point.
Right. There had been higher probability on a 75 going in, and now that reverse. At least last time I looked, 50 was the majority opinion.
And that's what we've been expecting, a 50 basis point, half point increase. And the terminal rate, the so-called terminal rate, the highest the rate's going to get in this cycle, I think I think you mentioned was well over 5%.
Yeah.
Is it still over 5?
No, I think believe it's like a quarter point higher than ours, right? There was one extra hike.
Our peak is 4 3/4, so it's about
it's in that range. Yeah. 4.75 to 5, right?
Okay. Yeah, and of course the stock market had a really good day, right? The Dow was up 1,200 points, I believe, and I think the stock market is not even down 20% from its all-time high set at the beginning of the year. So I guess investors are trying to time the end of this rate hiking cycle, because they know as soon as it's clear that the Fed is going to stop raising rates, then that's a signal to buy stocks, and thus the reaction. But you feel like that's premature?
I think so.
Yeah.
I mean, it's one report. It's a good report, no doubt. You want to hear negative? Well, gas prices, all right, energy prices went back up. Not a lot, but they had been coming in, and they could bounce back up again. So
yeah, I think that's the key. I mean, if oil prices stay where they are, I think West Texas Intermediate's just south of $90 a barrel. Brent is just north of $90 a barrel. And that's kind of sort of where we've been now for past at least couple, 3 months. Gasoline prices have settled in just south of $4 a gallon nationwide. They had peaked at $5 at all-time high back in June. We're down below 4. If they stay there, and that's our baseline forecast, obviously a lot of risk around that, given EU sanctions on oil, given potential OPEC more production cuts, given the brinkmanship with Russia over a cap on oil prices. But if that stays the case, then on because we got the big increases in oil and gasoline prices beginning very late last year, going into early 2022, on a year-over-year basis, we're going to start to see some real moderation in energy gasoline prices, and that's going to take a big bite out of top line inflation. In fact, I think if you do the arithmetic, as you said, right now we're 7.7% on CPI inflation year over year. I think by by March, April, in that period, May, we should be down near 4% on top line inflation, I think, just on a year over year basis. So, but that does depend on oil prices remaining stable. Does that sound right to you?
So that's taking out the energy, food, right? So I guess you're translating it into energy, food, and the supply chain constrained, right? Those either go flat or roll over.
Yeah.
As you put it, and
just simply go flat. Simply go flat. Then on a year over year basis, because you had that big surge,
right,
late last year, early this, then on a year over year basis, it really starts to come out.
Yeah.
It's really going to be the hard
next
part. That exactly.
The next 2.5 or so, or 2.
And that goes back to the labor market, wage growth, and of course that drives healthcare inflation, other service price inflation. We need to get that. That's going to be a little bit more. Well, it's going to be a lot more difficult to get back.
And the shelter, right?
And of course, the shelter.
That's going to continue.
But there too, I'm feeling really pretty good about that as well, because market rents, the current lease up rents, there's a lot of weakness in rents, and that will translate over by this time next year, starting to get into much more moderate rent, housing cost inflation, right?
Yeah, by this time next year. That's still, a ways away. It's not going to be immediate, so don't expect. I think there's a misconception that, because the asking rents are coming down pretty rapidly, then CPI is going to pick it up rapidly too, or within a few months. But it does take some time for those asking rents to work themselves through the CPI calculations, at least on the year-over-year portion of it, right?
But and I've articulated this a number of times now on the podcast, but just to restate it, to make it clear, the key, and obviously we're spending a lot of time on inflation because that's key to interest rates and key to what it means for the economy in terms of recession risks and that kind of thing. But over the next 3-6 months, I expect improvement in inflation, just the base effects, meaning those year-over-year base effects we just talked about because of stable oil prices and easing of supply chain issues. We also get a bit of benefit from new vehicle prices if they start to come in as we get more vehicle production. Then by the second half of next year, we get benefit from slower growth in the cost of housing because of what we're observing now with regard to market rents. That takes 6-12 months to translate over into CPI housing cost inflation. And then it's the first half of 2024 when I would expect to see a moderation in service price inflation, because at that point, the labor market should be weak enough, long enough, wage growth slow enough that takes the pressure off the service side, and we start to see service inflation moderate, and that's when we come back into the Fed's target of about mid twos. That's kind of the path as I see forward.
Mark, can I ask a question about that? We were just talking to some clients about this the other day, and the question was that we agree that that last 2.5 percentage points is going to be the toughest to kind of squeeze out. If we run into more trouble than we expected to at that time, squeezing that last 2.5 percentage points out, is that higher rates or is that high rates for longer at the Fed, or both?
Yeah, and I think that's the crux of the matter. I mean, there's two key risks to the outlook I gave. There's many risks, but two key ones. The first is we talked about oil prices and how that goes. Second one is what you just mentioned, and that is maybe the wage growth remains more persistent and entrenched, and you get more of that kind of self-reinforcing wage price dynamic that is very difficult to wring out. And you can't wring it out unless you have a recession to do so, how much higher unemployment. But, I think that at this point, my sense is based on last week's FOMC meeting that it may be the case that the Fed doesn't raise rates. It goes up to where we say it's going to go, 4.75%, 5% by early next year. and stays there for a while and maintains that high terminal rate for an extended period, well into 2024. So, by not raising rates more aggressively, they reduce the risk of generating some kind of financial event and also causing a recession. But they keep pressure on the economy with that high rate. That rate obviously is above it, the so-called equilibrium rate, which is consistent with a monetary policy that's not supportive or restrictive to economic growth, and it just keeps it there. The Fed keeps it there at that 4.75%, 5%, well into 2024 to make sure that the economy slows sufficiently that we get that wage growth down and inflation back into the box. I think that's kind of their thinking now, the strategy that they're going to pursue, my guess. And that's in our forecast. That's what we have in our forecast.
It'll be interesting to see how it plays out, especially because there's a day in November at the end of that you're talking about that all this is going to play into.
Yeah, great point. I mean, how this all plays out obviously will be critical to the presidential election in 2024, because if inflation doesn't go back into the box gracefully without a recession, then obviously that has all kinds of implications for how that election is going to play out. Okay, Cris, anything else on the inflation front? Let me ask you this, based on our bickering from last week, does this change your view at all with regard to the risks? You were at 70% probability of recession starting sometime between now and the end of 2023. Is that still the same? Any change there?
Data dependent, so of course this plus the Phillies losing the World Series, has brought my odds down to 67%. So yeah, I know. Big move.
Actually, that's a bigger move than people think it is, right?
It's borderline.
You want to explain why?
Well, that's our threshold for making a change to the forecast is 2/3
Right.
probability. So I would still make the change. I still think we need a little bit more slowing in our baseline, but getting closer to that knife's edge. If we get a few more reports like this, that narrow path the Fed is on could be realized. So.
Ooh, did you hear that, Dan? Emily? Did you get that?
I've said that from the beginning. 30% chance of that occurring, right? From the beginning.
Okay. Still pretty low.
Yeah. Hey, Emily, did you get Chris's reference to the Phillies?
No, I didn't. I know they lost.
Are you a Phillies fan? Are you a Phillies fan?
In her defense, she lives in Massachusetts.
I did the Astros. I saw that happen, but I don't know the significance regarding the recession probabilities and data.
Oh, yes.
Oh, it's in Mark's Twitter feed, right? You missed that one?
She's not watching. Are you a follower, Emily?
I am, but I'm gonna just blame a Twitter meltdown for not seeing it. So
you're right. There's been a bit of a meltdown in Twitter land. Yeah, a lot of Sturm and Drang. Dan, do you know what he's talking about, right?
Yeah, actually one of my students at Villanova brought it up to me as a reason why they should get off class the day after Game 7. I said, if they make it to Game 7, I will give you Monday morning off class. And they lost in Game 6. Everybody was very upset.
I bet they were. Yeah, Cris, you want to explain to the listener?
I think you should. You're the progenitor of this, right?
Well,
or at least,
okay, very very simply, and I think we've talked about it before. So the Phillies won a World Series in 1929.
Or the precursor to the Phillies.
1929 and 1930.
And 1930, and they were the Athletics at the time, but the precursor to the Phillies. Yeah. They won in 2008. Oh no, they won in 1930. No, wait, 1929, 1930, 1980, 1980, sorry, and 2008, right? So, Emily, what happened in those years?
Well, recessions.
Big time, right?
Yeah.
Big time recession.
So, see, originally I was unhappy about the Phillies losing, but now I'm kind of reassessing there. Okay.
Well, actually,
I can say that because I don't live in Philly anymore.
When you were going to get your morning coffees at Wawa, were you asking people about that? Because when I ask people around here, I explained to them that correlation does not mean causation, but every one of them said totally worth it. Totally worth it. We'll take it.
We'll take it. No problem. Massive recession, financial crisis. Phillies were in the World Series. We're going with the Phillies. We're going.
They were okay with it.
Yeah. Very good. Okay,
Gotta
well, I
have
think this-
priorities.
Yeah, I think it's a good segue into obviously the other massive event last week or this week, and that's the midterm elections. And I don't know how to begin the discussion, but maybe I'll just turn it to you, Dan. Do you want to give us a sense of, the state of play and anything else you want to say about it before we turn to what it might mean for the economy?
Sure. Yeah, I think the big takeaway is that nobody got everything that they wanted, and everybody got at least a little bit of what they wanted. So it just means that we're just about as divided as we were before the election. But there are some interesting trends that came through. So the Republicans, as of this recording, haven't officially won control of the House, but they're probably likely to win control of the House. We probably won't know who has control of the Senate until Georgia has their runoff. But either way, it's going to be a very, very divided Congress with probably one party in charge of one house and one party in charge of the other, but neither of them having a really significant hold on power in either one of those. So it's going to be some very interesting nuances in some of those votes. If the Republicans really do win the House, there are some folks who maybe not as core to the Republican constituency who have some power, who may not have had power before. I was just reading an article about how interesting it'll be when they try and bring up a vote on the $10,000 cap for state and local government when a bunch of their new congressmen are from New York and New Jersey, right? Are they really going to vote against the $10,000 cap?
Mm.
And on the Democratic side, you've got some folks who are from maybe more working class backgrounds who maybe vote differently than the normal Democrats do. And so the normal consensus within each party is really not going to be as firm as maybe it has been in previous elections. And so what that means is, and I have talked about this past, probably nothing gets done other than keeping the lights on for the next 2 years or so, which has some upsides for the economic outlook, but certainly some downsides as well.
Well, before we go there, Emily, let me turn to you. Anything you want to point out with regard to the election? And again, it's still, the ballots are still being counted in some key states, and we're going to have a runoff election for Senate in Georgia, which is going to determine whether, it feels like it's going to determine whether the Republicans or the Democrats control the Senate. Anything else you want to point out? I mean, there's a lot of stuff going on at the state level as well, correct?
Yeah, and I mean, at the state level, I think it's, in some ways, it's kind of the reverse of what Dan is saying. Like, we came into this election with very few, state governments having divided control by historical standards, and that actually intensified a little bit with this election. Like, we had two states, I think it was Michigan and Minnesota, flip so that they're now the same party as the governor. And then Democrat, yeah, of course. And then, with the caveat that a couple races haven't yet been called for the governorship, it looks like there'll be maybe 8 or 9 houses that are, or 8 or 9 governments that are divided, which is just really low if you think about it. So I think implications for that is these places will have quite a bit of, ability to make changes, to make tax changes, to make different changes to law. So we could see some more, less gridlock at the state level than we're potentially going to see at the federal level for the next couple of years.
So, but to try to synthesize what both of you just said, feels like to me the bottom line is it just means we are very divided and very closely divided. I mean, it looks like the Republicans are going to win the House, but they're going to win the House by what, Dan? 5 seats or 6 seats?
We can't tell yet. They need 218 to have control, and it's looking like their last count I saw was like 222, 223 probably. But there are 7 races that are totally toss-ups that no news agency is coming out and calling either way. So it could be 230, it could be 222. So we don't know. But neither side can really call. They got a little bit of what they wanted, but neither side can say, we definitively won this election. The Democrats, they lost the House probably, but they didn't lose it by nearly as much as they thought they would. So they're kind of energized. The Republicans probably didn't win control of the Senate, or we don't know yet, but they certainly didn't win the House by as much as they thought they did. But you probably have a Republican speaker at the end of all of this. So it's really kind of, nobody got everything that they wanted. And so both sides are going to probably steer that towards energizing their base as opposed to working towards the middle, unfortunately.
And of course,
Yeah.
just to make sure everyone understands, you need 218, correct? 218.
218 to control the House
House.
of Representatives.
And if the Republicans swept all of the outstanding elections, what would they have? Do you know how many House?
It would be almost 240.
240.
Yeah, but there are
Okay.
probably, and I'm probably butchering this, but there's at least 10 of those that probably have no way of going Republican, that are very lean Dem. They're just waiting for the count. So my best case for the Republicans is probably somewhere around 230. The probable case is somewhere 223, 230, 225, somewhere around there.
Oh my god! So the most likely scenario is the Republicans win the House, but they win the House with about a 5-6 seat majority, which is kind of sort of what I think that's exactly what the Democrats just had in the last Congress.
Yeah, they probably win maybe a 1 or 2 seat larger majority than the Democrats have now.
Yeah, one thing, and this goes now, we're kind of more moving into what it means for policy, but one other political question is, okay, say the Republicans win the House, McCarthy becomes the Speaker of the House, Kevin McCarthy becomes the Speaker of the House. Because it's such a slim, and he has 5-6 seat majority, which is very thin. What does that mean, in terms of his ability to manage kind of any kind of consensus in the Republican caucus?
It's going to be really hard. I mean, it's going to be really hard. I mean, it's going to be hard. I would imagine when we have the election of the Speaker next spring, it's probably in the wintertime. It's probably going to be way messier than usual. Usually all that stuff is figured out in the back room somewhere, and we all come out and we vote, and that's the way it is. But with some of the more diverse caucuses within the Republican Party, it might be more difficult to pull everybody together. And if it's that hard to pull them together on the Speaker vote, I can't imagine how easy it's going to be to pull them together on things like the debt ceiling or some of the fiscal policy decisions that are going to have to be made.
Oh, okay. So Emily, you said something that, and I don't think I got it until just now. What you were saying is, at the federal level, because it's so close, and because of what Jan was speaking about, it's going to be very difficult to get anything through into law. But at the state level, because it's become so polarized, you're either a Democratic state or a Republican state. You're either red or you're blue. All in. It's much more likely you're going to get stuff done because it's one party. That's what you were saying.
Yeah, exactly. And I mean, there's some
democracy.
What's
yeah,
that?
I mean, there's
So you're going to see all the laboratories of democracy.
Yeah, exactly.
Yeah, gonna get a lot of interesting policies out there. Yeah, because the federal government's now going to be divided, and I mean it was really close before even, and we could see how much that impeded the Democrats' ability to get some things they wanted passed. But I think the real thing is that a lot of places you've got the same control in the legislature as you have in the government, and so that's with variations across how big those margins might be across states, it's going to mean that they're going to have a lot of ability to pass laws and try out that new laboratory of democracy Dan mentioned. So
it's so funny. For most of my life, I've always wondered, why do we need to have states with such autonomy? I mean, this seemed to be kind of a mess. Didn't make a lot of sense to me. I could never understand the Tom Jefferson view of the world, where give states real power. I was kind of like always an Alexander Hamilton kind of guy, centralized power. And now I go, oh, now I understand. Now I get it. It's not a bad thing, actually, really. There's definitely disadvantages to it, but there are advantages. And that, to your point, Dan, it's a way to see what works, what doesn't work. You got 50 different data points out there to use.
Yeah, we were very blessed to have both Alexander Hamilton and Thomas Jefferson, because just one or the other would have made a really poor system of government, but having them both is what I think makes us great.
Yeah, and I think, the American political experience since its founding has been Tom Jefferson versus Alexander Hamilton. I mean, the whole way along, that battle continues to rage. I mean,
right, with both parties kind of switching sides over the course of history, which is kind of interesting.
Yeah. Oh, that's a great point. That's a great point. Yeah. Hey, Cris, before we move on to the economic implications in more depth, anything, from your vantage point on the election, anything you want to call out?
I'm just happy that the Republic held. right? There was all these,
Good point, good
and I
Really
actually
low
had,
bar, Chris. That's a really
I-
low bar.
I know,
It's
I
a
know.
bar.
I actually had clients, really concerned about civil war, or what are the implications? How do I calculate my losses if there's this type of disruption in the country once again? So I think it is a testament to some of the self-correcting power within our system, that we can have an election that seems like everyone is going to accept the results to a large degree. And I also think it was a vote for the middle way. I think Republicans, Democrats that were elected tend to be more centrist. I don't think there's going to be, although there will be gridlock, I don't think there's going to be a lot of tolerance for policies or discussions, debates that are not central to the problems that are really facing us, right? So I think we'll have good debate. We might not get a whole lot done, but I don't think we're going to be going off in a lot of direction. I hope we won't be going off a lot of directions or paths that don't lead anywhere.
Yeah, I hope this doesn't come across as being too political a statement, but does feel like the election deniers, the
Right.
candidates that were denying the 2020 election, that President Biden won election as president, those folks, there's still elections to be decided here, but generally they seem to lose out in this election. They didn't do well. Like here in our home state of Pennsylvania, we had this fella running for governor who was a very strong election denier, and he got creamed, by the Democrats. It's very, very unusual in a state like Pennsylvania, which is very definitively a swing state. There's red, there's blue, there's purple, there's everything. So I think that was pretty definitive. Dan, would you agree with that statement? Is that a fair statement?
Yeah, I think I can't remember who did it. Somebody did the math, and the candidates who across the House and Senate races who generally were more in the January 6th camp seemed to lose more often than they won. I think there's only a very few of them that won. But I think your point about Pennsylvania is a great point, because Dr. Oz and John Fetterman were razor thin, and the governor obviously was a much wider margin. I can't remember. I'd have to go back and look, but I can't remember a wider margin in the governor's race for Pennsylvania for a very long time.
I joke my wife determines presidential elections because we live in Chester County, Pennsylvania. Chester County is a really purple county, populous county, just west of the city of Philadelphia, which is obviously bright blue, but it's very purple. And my street is half Republican, half Democrat, and I know it because I can see it on this with the signs. And it's all about turnout on that street in Pennsylvania, because Pennsylvania in Chester County determines Pennsylvania. Pennsylvania determines. So I often joke, all these candidates should just be, talking to my wife, convincing her one way or the other about the election. But anyway, so the most likely scenario is divided government.
Yep.
The Senate we don't know. That's a toss-up. But what really matters here is the House flipping to Republicans, and that feels highly likely at this point. So let's use that as our basis for discussion. And Dan, if that's the scenario, what does it mean for policy? What does it mean for what gets done over the next couple of years, particularly economic policy, obviously?
It means not a lot gets done, which may be more of a feature than a flaw. I mean, especially with inflation as high as it is right now, we've been talking a lot about, I think there's a lot of people coming out and saying, fiscal policy should be helping the Fed, helping to make the Fed's job easier. Fiscal policy hasn't helped the Fed at all. We had the student loan stuff. We had a couple other things that are just kind of piling on and not making things easier. For better or worse, not being able to do anything other than keep the lights on is, probably a blessing over the next year to 2 years as we go into the 2024 election. That said, there's still a lot of risk out there that we can't physically do anything, which would be too bad, because there's some things we need to do to keep the lights on. We can't just send everybody home for 2 years. We've got to have the debt ceiling's got to be increased, which is going to be hairy, especially in the House. We've got the continuing resolution, which has to be extended. Hopefully it'll be extended during the lame duck, but we'll see. There are some things that just have to get done. And God forbid, we're talking about the odds of a real recession as opposed to kind of the slowdown or, growth recession that we've got in the baseline. If things get really off the rails, you're going to have to really convince a lot of very reticent folks to authorize additional funding if we go into a deeper business cycle than we're expecting.
Okay, so the Congress that's just ending, the first 2 years of the Biden administration, that was action packed. A lot of drama, but a lot of stuff got done. You got the American Rescue Plan, you got the infrastructure bill, you got the CHIPS Act, which provides support to the semiconductor industry to come here and produce here at home, and of course the Inflation Reduction Act around climate risk and prescription drugs, that kind of thing. So lots of things actually at the end of the day got through the legislative process because that was a unified government. That was Democratic control. And even though the Democrats only had a 5-seat majority in the House, they were able to pull it together and get that through. I mean, again, a lot of drama, reconciliation, so forth and so on, but they got it done. And what you're saying is now with a divided government, even if the Senate remains Democratic, because the House is Republican, it's hard to see anything getting done, at all.
It's hard to see anything getting done unless it really has to get done. And again, I think that's a good thing because, you said that it's been action packed, there's been a lot of drama, but it's probably too much has gotten done in the last 2 years. And I know not everybody would agree with that, but some of us would have said there's too much.
That definitely depends on, that's a political statement. That
I think too much has been done in some cases. And especially with this fight against inflation, that may not be a bad thing to have our hands tied a little bit in terms of going into 2024.
Now, here's the thing that worries me a little bit, and this goes back to the last time we had divided government under President Obama, we got into a real brinkmanship over two things. One is the funding the government. So the government has to pass these funding bills to keep the lights on, to pay workers and payout program, do the things that the government does. And if that legislation isn't passed and there's no funding, the government shuts down. And I think we had one big one under Obama, and we had two under Trump, actually, a small one and a big one. I can't even remember why. I think it was over immigration policy and the building the wall, that kind of thing. And then the other thing to worry about here is probably even much more important is the debt limit, that anachronistic law. So maybe I'll stop there, turn it back to you, and maybe you can explain those things and handicap them. Should we be worried about that in the context of history, that, last time we were looking at this kind of government, we had these kinds of problems?
Sure. Yeah, I think what it means is we have to go back to our slide decks from 2018 and 2013 and dust off our shutdown charts again. But the first one, as you mentioned, if you can kind of use we have our, I don't even know what it's called, our risk matrix, or what could possibly go wrong matrix. Yep. We've got the y-axis, which is the likelihood of something happening, and the x-axis, which is the severity. If I was to put the government shutdown, it'd probably be middle of the y-axis in terms of likelihood, and it would be very low in terms of severity. Very different than, I think 2013 was the first time we really had that government shutdown since Gingrich did it in the mid-90s. We found ways around making it as harmful as it was. There's some really bad regional economic things, and we work very closely with the states of Maryland and Virginia, and they're always very concerned about that because it has a big impact on their regional economy. But if the government shutdown doesn't last more than a couple of weeks, it's not a huge macroeconomic event anymore. Unfortunately, we become kind of immune to that kind of government.
I think just to put a finer point on that, I think based on those previous shutdowns, we estimate that if the shutdown is less than a couple of weeks, it doesn't register. But if it goes into week 3 and 4, each additional week shaves about 0.1% off of GDP in that quarter.
Yeah,
so that's
that third
it's
week
small, but you can measure it.
Yeah, the third week is really key because that's when people start to miss paychecks, right? And if you missed 1 or 2 paychecks, even if you're getting your back pay, it's going to really create some issues. And if we're in a weak economy already, or a weakening economy already, then that's something that could really kind of make the difference.
Right. Okay. But you're saying, okay, the shutdown, that's possible. And you're saying kind of a reasonable probability, kind of halfway up that risk rate. So like a, 50% probability, something like that.
Yeah, I'd say
it happened. Yeah, no, it might not be that big a deal if it's short. If it's longer, the longer it goes, obviously the bigger the deal. And the bigger the deal, the weaker the economy is. If that, depends on the state of the economy at the time.
Exactly. Yeah. And what really kind of matters is, and this is probably what's going to happen, it's probably going to end up with some type of continuing resolution. And that's just the way that we budget nowadays, which is terrible. But what that does is it doesn't give the folks in the agencies a whole lot of certainty going through the next couple of years. And it really can decrease productivity, can decrease hiring in some of those government agencies, which doesn't give us a whole lot of juice from an economic standpoint. So it's not ideal, but it's probably what's going to happen, and it's not going to cause a recession or be a huge macroeconomic effect. The second one that you talked about, though, that's the one that is hopefully very low in terms of the likelihood. I'd put it at maybe a third on the y-axis.
A third. Wait.
That's too high for me.
It's too high for me.
1/3.
Yeah.
A third probability or a third of the way
probability?
up that axis?
A third of the way up that axis. And remember, this is a
I don't know
totally
what the
objective
scale is.
axis, right? There's no objectivity in this at all. But you put the impact on the extreme, right? On the x-axis, it's all the way to 100, right?
Oh.
What's your probability straight up? Absolute
straight up? What's your probability?
If I was to put a probability straight up, I'd say 10%.
Okay.
Okay.
That's still too high.
That's still high. Yeah.
It's way higher. 0.01 is too high. It's the dumbest thing that we have in all of government is the debt ceiling.
Okay, explain what the debt ceiling is.
So the debt ceiling, the US government works differently than all of the states work and that most other governments work around the world, which is where we basically have to have a vote of Congress every time we want to increase our credit card limit. So if you had a credit card at home, imagine that on all the money you've already spent, right, you eventually get to say, you know what, I'm not going to pay back my credit card. I'm not going to pay back my debt. So they have to increase the credit limit. Otherwise, the Treasury can't borrow any more money in order to pay off the debt that we already have. And basically what you have under the worst case scenario, though, is you have a sovereign default by the United States, which creates unspeakable amount of bad things in the financial markets. Financial markets would melt down. I mean, there's no discussing it. It would be just about the worst thing that the federal government could do. Hopefully that never happens. And I think most people in government would say that hopefully that never happens. But with such a razor thin majority in the House and some people in the House who I think would genuinely want to take us over that waterfall, I think it's higher than it's been for quite some time. In terms
Yeah,
of
I would agree.
Do you see
Question
there?
for you.
Oh,
Sorry. If I can, quick question related to that. Is anything preventing the Dems from passing it now in the lame duck session? Why wait?
So in the Senate, they would need Republican help in the Senate to do it.
Why? Reconciliation. They could do a reconciliation bill.
They could do it under reconciliation, but I don't think they would for a couple of reasons. One, because that means that the Republicans can use that tool in the future, and Dems wouldn't be able to use the debt ceiling as a lever the same way the Republicans would.
Yeah.
But two, so far as I understand it, there is some dubiousness about whether or not it is possible to do a reconciliation.
Oh, you mean the rules under reconciliation may preclude a piece of legislation that would obviate the debt limit?
Yes. And again, I'm not a constitutional scholar or a parliamentarian, so I don't know that I can definitively comment on that, but I've heard people make very strong arguments both ways. So I don't know that the Democrats are all that confident that they can do it under reconciliation.
Yeah, just to make this clear to the listener. So under reconciliation, there's just another arcane budget rule that allows the party to pass a piece of, this is being lame duck when the House is still Democratic, get it through the Senate under 50 votes because the vice president would vote in favor,
right?
And you could you don't have to worry about the filibuster. And you can do one reconciliation bill each fiscal year. And of course, this fiscal year just started in October 1. So you could argue, okay, we could use a reconciliation bill, but there are some rules around what you can use reconciliation for. And so that's what you're saying. They might not be able to do it, even if they wanted to do it. And they may not be able to do it because all you need is one Democratic senator saying, I don't want to do that for whatever the reason is. Like Joe Manchin, the senator from West Virginia, did that for a long time with regard to the two reconciliation bills that got through, or at least the second one. The first one, the American Rescue Plan, that got through under reconciliation pretty easily. I think it was the second one, which ultimately became the Inflation Reduction Act that took 2 years to get done, basically because of one senator. Right.
Yeah,
Okay.
the margin is right now where one senator can hold the whole bill up and hold the whole thing hostage. So
Yeah. Okay. I do worry. Here's the thing that worries me, and I think I do worry about the probabilities as well. I'm not sure I put it 10%, but maybe is I do remember testifying in the Senate, and Rand Paul, the Republican senator from Kentucky, was openly contemplating a debt limit breach, and his thinking was, oh, you know, we can decide who we want. We can prioritize who gets paid and when they get paid, and we don't necessarily have to pay Chinese debt. He didn't say Chinese debt holders. I'm extrapolating. He was just saying we can navigate around the debt limit, no big deal. And I found that terrifying because let me just think about it for a second. You're a Japanese bondholder, and the Japanese own $1.2 trillion of treasury debt. I don't know how many China is probably close to $1 trillion. I'm not sure. I haven't looked recently.
they've been spending theirs down. They're a much smaller share of overall treasury debt.
Okay, so say it's 800 billion. I don't know. It's
still-
a lot of money.
still
It's
a
a
lot.
lot of money.
I think they're less than Japan now.
Oh yeah, I think Japan's the largest holder. Yeah, yeah, and even the Japanese are kind of getting a little wary of treasury bonds in the context of a 145 yen to the dollar. But anyway, so put yourself in the shoes of a bondholder from China, Japan, Middle East, wherever, and the congressman says to you, "Oh, don't worry, you're going to get your payment. We're not going to pay the grandma her full Social Security payment on time."
Yeah.
It's not going to happen. So the bondholder is going to run immediately. Interest rates are going to jump, and we're going to be in a mess.
Even if bondholders get paid, if somebody doesn't get paid along that waterfall, it's a default. And if you made a promise and you didn't pay on it from a government, that's a default. And so the fact that you did that at any level of that waterfall, whether it's bondholders, whether it's people on Medicaid, people on Medicare, you only have to do that one time and you're done. The rest of the people in that waterfall are not going to trust you again. And that's the real cost of this, because so much of the global financial system is based on that US Treasury rate being the risk-free rate. That as soon as that goes out the window, all hell's going to break loose in the financial market.
And by the way, this is why I love Alexander Hamilton. One of the reasons, right? Because he understood this principle, and he back in the Revolution, all the states issued debt to finance the Revolutionary War. At the end of the war, investors in those debt, they thought it was basically a gift. I don't think many thought they'd ever get their money back. And it was that debt was trading at pennies on the dollar. And hedge funds at the time, the analog to hedge funds today, they weren't hedge funds then, but they were the analogs to hedge funds, were going in and buying these notes, for treasury debt. And Hamilton said, okay, I'm going to buy all those notes back 100 cents on the dollar, to the hedge funds. And by so doing, establish the credit of the United States of America. We're the Lannisters of the world. We pay our debts. Emily, do you understand that reference?
I got that one. Yeah.
Okay, you got that one. It's above Chris's head. He didn't get that. He didn't get that. Everyone else did, but Cris. That's okay. That's okay, Cris.
Once in a while,
Once in a while, that's true. I'm usually the one where it goes over my head like this. But anyway, we pay our debts on time. We pay our debts, and we pay our debts on time. And by so doing, we pay the lowest interest rates in the world. We're the reserve currency on the planet with enormous benefit because we pay our debts. And as soon as you have any shred of doubt that you're not going to get paid your money on time, to the second that it's due, you got a problem. But anyway, I agree. I worry about that. I think that's something to, come to the fore here at some point in the next year. So I'm not so sure, Dan, I'd be as sanguine as you as saying, it's okay, we don't do anything. If it's
so I think that one's going to get done. So we can argue about where it is on the y-axis. We all agree that it's like 1,000 on the x-axis, right? It's infinity in terms of severity. But in terms of the fact that it's even a little bit up at all, regardless of where you would have it, is going to make some people nervous. It's going to make financial markets nervous, because what will happen is in March or whenever we get around to the next debt ceiling, is there's going to be brinkmanship and everybody's going to hand wring, and you're going to be on CNBC talking all the stuff you just said, right, about how bad it's going to be if this actually happens. And then at the last minute, they'll make a deal, right? That's what has happened traditionally over the last 10, 15 years.
Well, here's the thing though. Here's the thing that even worries me about that scenario. Because you just articulated that everyone's thinking like you are. So markets aren't going to react at all. They're not going to react at all. Oh, no worries, no problem.
It's a
We'll
bluff.
take it right down to the midnight hour, and we'll pass a piece of legislation. So there will be no signal from financial markets that anyone's at all concerned. And then the Rand Pauls of the world are going to say, and I'm sorry to pick on Rand Paul, he's just, because of what he said. Oh, look, financial markets aren't worried at all. And we go over the waterfall.
Yeah.
By the way, I wouldn't use waterfall as a metaphor. I'd use, cliff. Waterfall has this kind of nice fuzzy connotation. It's cliff. It's cliff. We're going down. It's like coyote. What Wiley Coyote. Emily, do you understand that reference? Wiley Coyote.
Yeah,
Chris,
more vaguely, but yeah.
Chris, I thought I'm old enough to understand because I watched those. That's what I watched when I was a kid. Wile E. Coyote. I don't know.
They still work. I still show them to my kids.
Okay, very good. All right. Anyway, okay. So Emily, I got a question for you with regard to state and local governments. But before I ask my question, is there, what kinds of as you said, we've got these now states that are dominated by one or the other party, and we could get to see a lot of things happening here. So kind of what's at the top of the list of things that could happen from an economic perspective?
I mean, the potential good part would be, states have money still set to allocate from some of that federal funding. They maybe could get their act together well to make sure that they allocate that, they get projects moving, they get infrastructure projects on the ground. That could be, effective state government moving along. What kind of is more concerning for me is that states have been kind of enjoying these huge windfalls of just having a ton of revenue come in lately. And I worry that, having, this consolidated government could maybe lead them to over allocate, overspend, over rely on that money kind of continuing into the future, whether that's new programs that they're funding or whether it's tax cuts. We've already seen a lot of states passing tax cuts. So I think continuation of that, amplification of that could be potentially concerning as we go into the next couple of years where they're not going to see that massive growth in tax revenue they've been kind of starting to rely on.
Great, good. But there's no kind of one burning economic policy issue out there
that's the beauty of state government, is there's a
Yeah.
huge amount of variation there.
Yeah. Okay. Dan, anything there you would add that we might see at the state and local level?
I think a lot of the things that you'll see that both parties are advocating for at the federal level and national level are going to play out at the local level. They're going to try it there first. And that's where you'll see, one, who's got the political, is that really winning in the political arena when they do that? And two, is it working economically? So, the Republicans are going to try and have more tax cuts. The Democrats are going to increase a lot of these spending programs, especially on social services and things. And how that gains momentum up to the federal level is kind of usually how we get these federal programs eventually through one way or the other. So it'll be interesting to see who gains the momentum by doing that at the state level.
Hey, here's my question, and I'm not sure I'm going to articulate this well, but hopefully I get the gist of it across. Do you think we could see kind of self-selection going on across states where, Republicans tend to start living in some red states and Democrats start living in blue states, and we actually fracture? One of the beauties of the American experience is that we're kind of a hodgepodge. We all melted together, and we got Republicans and Democrats, got all kinds of ethnic groups, minorities, kind of all. We've got communities, and there is some segregation going on across all these different groups, but generally, we've had a mixing, right? And actually much more so in recent decades, because we've seen this massive flow of people from the Northeast and Midwest into the South and the West, and the country looks a lot more similar today demographically and industrially than it has ever been. But now it feels like it might be moving in the other direction, that if you go take a look at the state of Florida, for example, it's turning increasingly red because you got a lot more, it feels like Republicans moving into, this is just my sense of things. And I'm not, the question is that happening? And is that something we should be worried about? And also in the context of the abortion laws, right? Because of the biggest now distinction between states, might be with regard to abortion laws and rights. And that could have very significant effects on, who wants to live where. Is that something you're observing? Is that something we should be worried about? What do you think, Emily?
Yeah, I mean, I don't. I want to go to look to the data on this, and I don't know that we have a clear-cut idea of that at this point. I think, this polarization, obviously is concerning. Obviously, abortion rights are on a lot of people's minds right now as far as choosing, I think where they want to live, or I think Adam Kamens, who does our regional work, has done some good work on whether that would impact where people want to go to college, which maybe could impact things on a longer term basis about where people settle. So I don't know that we're seeing it yet. And in the reverse, we've also seen some of these rapidly growing cities, thinking like Boise, Idaho, for example, where people are still moving to despite maybe not always aligning with the politics of the area. But so I think I don't have a good answer for this. It's something I definitely want to watch. But I don't know. It kind of depends also. I feel like in a bit, this past election was a little bit of a repudiation of some of that more extreme views. So maybe there's some natural checks there where if states don't get especially extreme, maybe we won't see it manifest, but I think it's going to depend how that plays out.
Yeah. What do you think, Dan? Am I barking up the wrong tree?
No, I think you're onto something. I think it's interesting. I think the advent of remote work has just accelerated that a little bit, maybe because people don't need to be by the industry, right? They can go work. A lot of folks, especially in the services industry, can go work wherever they want, right? In office using service industries. And I think we're seeing that. It's not just the retirees moving from the Northeast to Florida or Texas. It's people with people in their 30s and 40s with jobs and kids move into those places, which is interesting to see the demographics. And demographics is destiny, so it's going to play out. But I think near term, there's other things at work. Florida is a great example. So Marco Rubio absolutely annihilated his opponent in the race the other day, and so did DeSantis. His margin was enormous. But what shocked the heck out of me was when we were looking at the results, it was that Miami-Dade County, they did better than any Republicans done, and I can't remember when. And it's not that the demographics are there, right? It's a bunch of Hispanic voters who have started to vote red instead of blue, which is more of a messaging thing around those platforms, I think, than it is a real demographic story. So there's cross currents going both ways, and I don't know that we can tell just by looking at the voting data that. But if we look at the demographic data and how it plays out in the next 10, 20 years, it's going to be really, really interesting to see who the swing state is in 5 years.
Yeah, I think it'd be a good research topic. Let's see if we can't kind of, because there's a lot of moving parts here, so it's hard to disentangle things. But maybe we can do a little work, try to identify that if there's kind of a, if you look at net migration state to state, and have a kind of a political variable as one of the explanatory variables, and see if it's significant or not in terms of after controlling for everything else, all the other things that affect migration flows. It might be
you could do that. You could tie it into we have voter registration data by state that you could actually look at, and you could take that down to the county level. Actually, that'd be really cool to do.
All right. Well, so the listener, this is how we decide what research we're going to do. These kinds of topics is kind of how it happens. Cris, anything else you want to add here on these issues before we call it a podcast? Oh, we got the game. I forgot about the game, the statistics game. We got to do the statistics game. We'll do that right after you opine here. Anything else you want to say?
No, well, I'm really interested in the last study topic you brought up, because I do think there are a lot of other cross current, like housing or being locked into your homes.
Yeah.
Can people even move to places that they might want to move to? Given the housing situation. So I think there are a lot of other considerations. So there'd be an interesting regression. Complex.
And also
one,
there's confounding factors, like, you could say, I think, and I don't think I'm mischaracterizing, but older populations tend to be a little bit more Republican, younger populations a little bit more Democratic. And you got a lot of retirees now moving to, places like Florida, and maybe it's age and it's not.
But we have age. We have the net migration data by age, so we
No,
could
I know,
actually
but
look
I'm
at
just
that.
saying,
Yeah.
you got to control for that.
Yeah.
You got to
Yeah.
control
Yeah.
for that.
Yeah, for sure.
It gets difficult to disentangle. But anyway, okay, let's play the game. Geez, how can I forget that, man? Who wants to go
We've had
first?
listeners waiting for the last hour
I
just to
know,
get to
I
this
know,
game.
I know. And we got a few. I know we have a few good ones. Cris, you want to go first? Just show us how it's done.
Sure. 39.1.
39.1. Is it related to the election?
No, but it is 39. I'll give you units, 39.1%, just in all
Okay.
fairness.
Is it a statistic that came out this week?
Yes. Yes, that is
Uh,
one of our rules.
It has to be this week, right? That was the rule.
Well, sorta. I can break the rule every once in a while. Yeah, I'm allowed. Is it from a survey?
Yes.
Is it from the NFIB survey?
No.
Is it from the University of Michigan survey?
Nope.
Oh, is it the loan officer survey?
Yes.
That's what it is.
Senior loan
Oh, I
officer
was
opinion
looking at this
survey
yesterday.
4.
Oh my gosh.
What was 39.1%?
Commercial industrial loans.
Tightening
The
standards. Yeah.
Lending standards for C&I loans. You want to?
For large and medium customers.
Yeah, well, you want to explain it?
Sure. This is an indication that the lenders, the banks, are getting are tightening up on their credit, right? Presumably out of fear of profitability and the ability of these businesses to pay back. 39.1% is a high level of tightening, and is one of our key recession indicators, right? So we've at this level, we've always had a recession. The survey only goes back to 1990, I believe. So we don't have many recessions to compare against, but this level of tightening is consistent with recession within several months.
And this is doesn't tell you the intensity of the tightening down in underwriting. It's just directionally the underwriting has tightened. Yeah,
That's right. That's
Yeah.
right.
yeah, that's a good one. That's a really good one. Okay, Emily, you want to go next? Oh, by the way, that was an example of teamwork, I thought, in terms of getting that one, right?
Teamwork makes the dream work.
But that no one wins a cowbell based on teamwork in this game. Yeah. Very individualistic thing. But anyway, good one. That was a good one. Emily, you're up.
Okay, I think this should be an easier one because I didn't want to start this off.
Oh, anytime
but-
you preface it with this should be an easy one.
We're
No,
doing
but
it.
like
You
actually,
look ridiculous. Okay, go ahead.
0.75.
Is that from the CPI report?
Mhm.
Is that a yes?
Yes.
Oh, okay. Yeah, you got to say yes. You got to say yes.
Yeah, I forget that this is going to be audio for most people. Yeah.
And your nod was kind of a very, very.
It is definitively positively from the CPI report.
Nice. Okay.
Top
Is
line
there a
inflation
difference?
is up 0.4. Is it a month-to-month increase?
Yes.
Okay.
Oh.
Is it one of the components of the CPI?
Yes.
Is it housing related?
Yes.
Rents?
Oh, housing related. Okay, so is the cost of housing services?
Yeah, it's just the top line there.
Top
CPI
line.
and shelter.
Yeah,
Yeah.
top line.
Oh, shelter. Okay.
Shelter. Yeah. Okay.
Yeah.
Okay. I don't. I think. What do you think, Cris? What do you think of that statistic?
How did you get the second digit?
How'd you get the
I
second?
went into Fame
Oh,
and I
you
looked
went
at
to
the
the- oh.
non-seasonally adjusted because
Oh,
I
okay.
figured if I just
that,
gave the
all right.
rounded
all
one, it
right.
would be a
Fair
little
enough.
easier. So
That was a
Yeah.
little tricky.
Way to throw Chris off. Just add a decimal point.
Yes. Well, I looked
it's
at the
extra
report.
precision. It's extra
I
good.
looked at the
Yeah.
report. That's right.
Yeah. Figured.
Oh,
You gotta remember that
interesting.
for next
Well, hold
time.
on. I think they don't give you the second significant digit, do they?
But it's an index, right? So like if you look at the percent change in the index, then that'll give you another digit. If you go in Fame there, if you go into
Carl's
and do
team
the
does
percent
it-
change,
Yeah,
Yeah.
Carl's team does it to more than
we've
one
got it
person.
banked. Yeah.
Okay. Huh. Okay, very good. Because in I think in the CPI report itself, they round down to 0.7, don't they? They don't
Correct.
round up to 0.8.
I think, yeah,
Yes.
Okay. Okay. All right. Very good. Very good.
Tricky.
Okay, Dan,
but
you're
good.
up.
You guys are up. All right, my number is 43.4 billion with a B.
40, what is it? 44?
43.4 billion.
Is that how much? 43.4 billion. Is it related to the election?
No.
Is it related to the budget?
It is a release that we cover on Dismal that came out or on Economic View that came out this week.
Is it related to the Treasury budget?
It is.
Oh,
Bernard's not here, so I had to stump you guys that way.
Yeah.
is it something about the space left under the debt limit or don't even know what the magnitude would be on that?
Well, we got the October Treasury report this week, and it was the first month of the fiscal year. And 43.4, I think the deficit was it a positive 43.4 or negative?
It was a positive 43.4.
Is it how much we spend on interest in the month?
It is. It's the net interest paid out by Treasury.
Oh.
oh,
Oh, that's a good one.
That's
Okay.
worthy of a cowbell.
That is a cowbell,
good.
baby. Oh, that's impressive.
that was
I have to
impressive.
say.
That was
Who got
impressive.
that right? I'm just asking.
Well, you didn't specify if it was gross or net. I should have checked you down by that.
Not a
But-
trick question.
That is 1.5 times more than we spent last October.
Is that right? Wow.
Yes.
Can I ask, I mean, in my mind's eye, I have interest expense is of the federal government is 2% of GDP. And that's
More or less,
low. That's low by historical standards. I mean, when it gets above like 4 or 5, that's when alarm bells go off, because then you can say we're spending more on interest than on defending our country, which doesn't make sense to anybody. And we
Yeah.
do something on the deficit. What that 43.4, what that would be?
So CBO and OMB over the summer both projected that it would be about just over 2%, like 2.3% this year. But that's way stronger than CBO and OMB assumed when they did their interest rate forecast over the summer. So it's possible. So just for context, in 2022, we ended up spending like $450 billion on interest that year, or the previous fiscal year. If we keep going at that rate, we're going to be over $600 billion this year, which would be the
Wow.
highest we've paid, I think, ever on the debt.
Yeah, but yeah, okay.
But as a share of GDP, it's
Yeah.
closer to 3%, I think.
Okay. But still that, I mean, it's creeping up. 2 is low, 5 is a problem, 3 is
Yeah.
okay, but moving in the wrong direction, obviously.
Well, the reason people are freaking out about it is if you look at the total number, that's 600 billion, that means by 2025, 2026, you could be over 700 billion, which is actually more than we spend on national defense, which is a nice kind of
Yeah.
notable point that everybody's going, oh my gosh, we're spending as much on this as we are in defense. And so people are starting to pay attention. But it's one of the reasons why I think it'd be very hard to convince some folks to come along with anything that has to do with fiscal policy over the next 2 years, other than keeping the lights on.
Yeah. Yeah, no, I think on both sides of the aisle, there's a lot of increasing angst about the deficit and debt. Yeah, for sure. In a high rate environment, for sure. I mean, historically, you didn't worry too much of interest rates, long-term rates were below nominal GDP growth, because if you had that situation, then the debt to GDP would decline. But now nominal potential GDP growth, interest rates are about equal to nominal potential GDP growth. And so you don't have that benefit. You can't rely on that anymore. It's going to become much more difficult. I'm not going to give, we're running out of time. I've got a hard stop. So you'll have to wait till next week to get my statistic, but that was very good. I really appreciate it.
You can tweet it out.
I'll tweet it out. That was a great conversation, very informative. And the other thing I didn't ask, the biggest news, of course, was Cris going from 70 to 67%. I have to say that was a huge deal. That was the biggest news of the week from my perspective. So we'll any last words of wisdom before we call it a podcast? Hearing none. Thanks, Emily. Thanks, Dan. Thanks, Cris. Thanks, guys. Thanks, everyone. Talk to you next week. Take care now.